just talk about the markets and what we think is going to be happening. I think the Fed's in the trap. I think we're going to have about 6 months, say at least, for rollicking good gold and silver and base metals market, which is good news for everybody here. Bad news is I've been wrong before, so we'll see how it works out. But let's check out the evidence that I think is compelling for why we're going to have really good days ahead for everybody in this room. Why the Fed is trapped. The Fed's attempting to tighten monetary policy, but very few people, you won't see this on CNBC or anywhere else, very few people realize they can't get very far down this road. And for two fundamental, very powerful reasons. The first is addicted markets. The markets are not only addicted to easy money, they are addicted to ever easier money. This is an important concept. You can't go back and do, the Fed can't go back and do what it did last time. It has to accelerate it, the program. It has to do more, considerably more than it did last time, because the addict has grown tolerant to the drug. It needs more of the drug, more of that monetary adrenaline to achieve the same effect. And in the process, they've created towering financial houses out of cards. Easy money builds bubbles. Here's the S&P 500 is in the black line, and you'll see that the blue line are Fed assets. And the correlation is well over 90%. It's been like 95 to 98% through most of this period. The major divergence was really right when COVID hit, when it took literally about a week for the Fed balance sheet to catch up to the decline in the equity market. But they were very quick back at that point. Home prices versus Fed assets. This was one of the things they wanted to do. One of the goals was to prop up financial and real estate markets. That they did, as you can see, the median home price soared along with the Fed balance sheet. Again, tremendous correlation. Easy money also builds bubbles. If you go back to the early 1980s, this is post-Volcker, you see that whenever there was a recession, whenever there was any kind of a hiccup, not even a recession, but just some kind of a slowdown in the economy, these gray bars represent recession. The Fed responded with the same prescription. They lowered interest rates immediately, quickly, but you'll see that in every instance, they went lower than before, and when they tried to recover, when they tried to normalize rates, they didn't even get back to the midpoint of where they were before. So it's been a stair step from, say, the second floor all the way down to the basement, which was reached post-2008, and again, post-COVID. They really weren't able to raise much at all post-2008 when they tried to normalize. Next step is into the basement. Negative nominal rate. They have not officially, if you parse the language, ever ruled that out. So it remains to be seen, but that's where the trend goes in the next crisis. Low rates also encourage the buildup of, anybody? Unmanageable debt. Years of managing interest rates ever lower in response to economic slowdowns foster the creation of towering debt loads. This is the second reason. A lot of people, hardly anybody, really recognizes this, won't see it in the mainstream financial media. This is really the roadblock, the brick wall facing the Fed, why they can't get too far down the road of policy normalization. National debt, 30.35 trillion right now. Just 2 months ago, or $350 trillion ago, $350 billion ago, it had cleared that $30 trillion number. This is out of control, absolutely out of control. We're over 125% on debt to GDP, and this trend is accelerating. And it will accelerate the debt to GDP as we get into the next recession that's being forecast by the yield curve. Today's debt load prevents the Fed from normalizing rates or anything close to it. And I'm going to show you the evidence why. First off is federal debt and Fed interest expense. Now, these are data series that are from the Fed itself. And what you can see is that interest expenditures, that's the blue line, is incredibly sensitive to the level of interest rate in the Fed fund rate. So federal debt, as you can see, is the red line, and interest expense fluctuates. If you look at, say, post-2008, this period right here in the recession, you'll see the federal debt rose, but interest expense, what they pay every year in interest on the federal debt, plummeted. That would seem to be contraindicative, and in fact, that shows how sensitive interest expense is to the level of interest on Treasury debt. Similarly, post-2015, post-2016, the interest payments soared and the federal debt soared, but interest expense soared because the Fed started to raise rates. So let's zoom in on that a bit. If you look in 2016 or the end of 2015, the Fed's first rate hike in December 2015 was a 1/4 point. And you'll see that government interest expenditures, again, the blue line, barely reacted to the first Fed rate hike. Then federal debt kept coming along, but all of a sudden, interest expenses soared. And remember, when the Fed started raising rates in December 2015, they did it at that lightning speed of a 1/4 point a year. The first 2 years, it was a 1/4 point interest rate increases a year. But look how quickly federal interest expenses rose in response to that. The lesson here is that the cost of servicing the debt is enormously sensitive to the prevailing interest rate. And this, remember, was about $10 trillion ago in the size of federal debt. The point being that the federal debt now has grown so large that this dynamic means that interest expense, the cost of servicing the debt every year, are going to soar as the Fed tries to normalize rates this time. Now, very few people, nobody really, I've always wondered, what is the actual interest rate on the federal debt? You can ask anybody, and all you get are vague answers because obviously interest rates fluctuate, maturities fluctuate. They're all over the board. It's a moving target. So I decided to just go back to the Fed series, data series, and divide their interest expenditures by the federal debt, get an effective, simple interest rate on the federal debt. Note that the rate of interest on the national debt generally runs about 2 to 4% above the Fed funds rate. It can get much larger. It can take a little while and collapse a bit to adjust. It did at that point and post 2008, but it's generally 2 to 4%. Now, what are the implications of this? The implication is this, that by the time the Fed really starts to increase rates, which is going really right now, the amount of federal debt owned by the public, then in this case, you have to use owned by the public because other interest expenses net against the federal balance sheet, will be about 25 trillion. If the Fed gets to 2% on the Fed funds rate, if this previous dynamic holds that we're 2 to 4% above the Fed funds rate on the interest, simple interest on the federal debt, that means that we'll be paying about $1 trillion a year, every year, in interest on the federal debt. I think that's a political roadblock. I think that in an era when we're talking about universal basic income, forgiveness of student debts, a lot of fiscal spending, that there will be serious talk about why are we spending $1 trillion a year on one line item for hedge funds, big pocketed investors, China, anybody holding federal debt when we could be using that money for much better purposes. So that, I think, is not only a roadblock because it'll be fiscally impossible to pay this amount, but politically impossible as well, and cause some doubt about the relative health and stability of the U.S. dollar. So the implications, again, the Fed will not be able to significantly affect inflation, and in fact, will need inflation to depreciate this debt load. Also, the Fed will have to turn back from its Fed rate hike campaign, either due to market pressure. The markets tell the Fed you have to turn back. They will do so because the stock market, the financial markets now really are the U.S. economy. There's so much wrapped around it. It's so embedded in the U.S. economy. The Fed is beholden to the market. Markets tell the Fed to stop, they will stop. Or we hit that debt service brick wall, which I think is around 2% on the Fed funds rate. If you believe what they're saying right now, we're going to hit 2% this year. If they keep that rate, I don't think they can, but this could happen very quickly. It would probably take about a year afterwards for those interest expenses to react, but it is a brick wall. We're not getting too far down that road. What it all means is that metals and mining will rally as the Fed continues to hike rates. But once Powell and company are forced to retreat, which they will be at some point, metals, mining, and all tangible assets will soar in a second phase of the bull market. I think we have two phases here. One is reaction to the Fed rate hikes, which is bullish for the metals, and that second phase when the Fed is proven to be impotent in fighting inflation. Why are rate hikes good for gold? That's a good question. But it's not deniable that they are. The evidence points to this. This is from Incrementum AG, Ronnie Stofley and his group at the Do Gold We Trust report. Fantastic report, free, best annual report on gold out there. You can see that gold in that gold brownish bar. This shows the last 4 Fed rate tightening cycles. Gold has, this is 1 year before, 6 months before. Gold doesn't react, it's negative return. 6 months after, positive. 1 year after, positive. The green bar is U.S. stocks, and the red bar is the U.S. dollar. So last 4 rate hike cycles, gold has benefited. Let's look in a little more detail. This is post-2008. These are Fed rate hikes. 9 rate hikes post-2015 in the post-2008 financial crisis. 9 rate hikes. 7 of these 9 rate hikes, gold reacted positively to it. This is an accidental repeat of that chart, so please view. Let's look in more detail at the Fed's first rate hike in December 2015. You can see that post that rate hike, we had about an 8-month really rollicking bull market in gold and silver and junior mining stocks. Gold went up about 30% over that 8 months until August of 2016. The typical junior mining stock went up about 150% during that period. We had outperformance, obviously, and underperformance by some, but that was a tremendous environment. People who were positioned in junior mining stocks made an awful lot of money in that process. Notice the chart ends there, so we don't see what happened on the way down, and a lot of us stuck with our stories that we were so in love with. But that's the analog right now. This is the analog. Fed started off with a quarter-point rate hike. This is bullish for gold. I think it's because there's kind of a rolling short in gold as the next big news event is the Fed hiking rates. When they actually begin to hike rates, having bought the rumor, those short sell the news and look for the next big event. Next big event is when the Fed has to turn back from this rate hike cycle. Again, that's what I think will launch the next phase of the bull market. A few technical charts, and then in my remaining time, I can take some questions from the audience. I have a friend of mine, Ron Grease, at thechartstore.com. Highly recommend his service. He has a weekly blog that's absolutely fantastic, comprehensive blog on all the markets. I'm not a real accomplished technical analyst, but I do follow this 14-week stochastic. It has turned upward, although Ron says it's still neutral right now. The key thing here is this kind of whippiness in that stochastic corresponds to a similar period post-2008. So that post-2008, when the Fed really started implementing its policy prescription, the price of gold nearly tripled over the next 2 years. So that, I think, is positive. for gold. This is important just to illustrate that saucer and handle, cup and handle formation. This breaking out from this formation, we're in the handle right now, and it looks like we're beginning to break out. If you take the count from this formation, it goes up to at least $2,500 on the gold price. I've seen some people talking about a minimum of $3,000 on the gold price. That portends really a strong run to far higher levels over the next couple of years. Silver is similar. It was a bit whippy on the stochastic, now actually delivering a buy signal. What is important here, something that Ron's been pointing out in his charts, is this flag formation. If and when gold breaks through this upside resistance and this flag formation, it counts into the 40s. So that implies a tremendous move higher in silver. And any of these junior miners who are leveraged to that or in that sector will do very well. Remember what happened post-March 2020, had a big run in gold and silver. Those silver junior mining stocks were extremely leveraged to that move and made a lot of money over a short period of time for their holders. Copper had a really good move last year, and it's been kind of backing and filling that move. And it looks poised for a breakout. In fact, if it breaks through this line, we'll be well into $5 once we break through that upside resistance. I think I'm very bullish on the price of copper long term. I think we're looking at essentially $8 copper over the next 4 to 5 years, thereabouts. You just can't find enough copper to hit this wave of demand coming. I know a lot of people agree with that, but if you find good copper plays, stick with them, I think you can make a lot of it. And that's it. That's me. goldnewsletter.com. Please subscribe to find what I write about every month and in between. And New Orleans Investment Conference this fall, October 12th to 15th. I highly recommend you go to that. If you have any doubts, just ask anyone who's been. You have a couple of minutes for questions. Any questions? Brent, I know you have a question. You got a smirk in your face. You got to be wondering about something. Yes. Yeah.
Can they actually do besides that? I mean,
what can they do?
Yeah. What are their options that'll work better?
They have none. What we're looking at is a cycle that started. Well, you can go back to 1971, go 10 years beyond. Before that, two guns and butter in the 60s created the situation that forced Nixon to abandon the close the gold window. And look at that as a cycle. But that cycle I showed you post-Volcker, where in reaction to every crisis, they lowered rates, ever. Now they're at zero. What we're seeing is that trend playing out. Now, I don't know if this next crisis is going to be the one, like Peter Schiff says, that blows up the dollar and loses all credibility. I don't know if it's the next one or how long it is up. But with each succeeding cycle, the dollar in all currencies lose credibility. So we're in the end game of that. Whether that end game is 1 year, 2 years, 5 years, 10 years, we're talking about a multi-decade cycle that is approaching its end. So that's what I'm saying. They're in a trap. I don't know that they have a way out. Now, Volcker came along in the 1970s to quash inflation by raising interest rates to, what did we peak at? I don't know. What did we peak at on the 30-year treasury? 16%, 15.5%? Yeah, it might be. Anyway, he got interest rates above the rate of inflation, which is key. Have to limit and to really corral the economy, to really stop that overheating, have to get interest rates positive on a real basis. So that would imply now, of course, interest rates of 8%. Not going to do that. They can't raise rates enough. There are two things. There's not a Volcker around today. Nobody's going to crash the economy to kill inflation. And the debt is much larger than it was in 1970. The debt in 1970 was about 30% of GDP. Now it's 125, 130%. Simply cannot cannot raise rates enough without not only crashing the economy, but sending the interest rates up, slumping the whole budget with the cost of servicing debt. And I think that does it, and I think we're ready for our panel. Adam?
You've got interest, and then you've got the dollar. All things equal, interest rates go up, the dollar is going to go up, and that being said, all things equal, the dollar goes up. Dollar-based commodity price is going to go down. Please comment on the relationship, that relationship.
Yeah, interest rates going up is, can't take that in a vacuum, it has to do with inflation. So they would have to get interest rates above the rate of inflation. Positive on a real basis, not just nominal. We just saw a 10-year yield on the Treasury, 2.5%. 2 months ago, we would have said that was going to go down to $1,700. You had 2.5% a couple days ago, gold was up $20. So people are starting to look at the rate of inflation, real rate, instead of ignoring real rate. They're looking at that. The market's come to, I think, accept that.
Just additional comment is that, a relative point, so we have to
Yeah.
look at the rest of the world. Is your view that Europe's so muted right now that it just doesn't have an impact in that sense?
I think it is a relative thing. When I talk about, I don't particularly like to talk about debt to dollar, credibility to dollar. I like to talk about currency in general. Yeah, currency. I think Brent Johnson has some great points about the dollar being the clean shirt and the dirty laundry, yada yada, all that. But I think it's currencies in general. The dollar index kind of meaningless. I think the real value of the dollar is measured by gold.
Okay, wonderful. Brien, thank you so much.